Hey gang, welcome to Time in the Market episode 9, I think. It's been about a month since I did my last portfolio update, so I thought it'd be a good idea to kind of jump back into it and kind of give you an update of where the portfolio sits today. I haven't really been putting a ton of money into this portfolio in the last couple of weeks, but it's grown pretty well. You can see over here that the portfolio as of the last update was about 39.7. We're sitting at 42.5 right now, or a gain of about 2.7 thousand. Forward income on this portfolio is about 683 bucks, a little bit of a gain based on some changes to the portfolio and also some additional money flowing into the portfolio. So where has this growth come? In the last month, the S&P 500 is actually down just a little bit. Started about 32.30, 32.40, something like that at the beginning of June. Now we're a month later in July. We're down about 2.5% as of today. It's up slightly, which, given all that's going on in the world, is actually pretty darn good. Year to date, after that dip, we're still down a bit, but not down that much. Going 1 year back, the stock market is relatively flat. It's up a couple percent actually. So even those who invested in July 2019 are still profitable, which is crazy to think about given what's happened since then and the level of unemployment we've had. But hey, this is why you can't time the market. You just got to keep being invested, keep buying when things look bad, like they did here, and keep buying when things look good. So I certainly was buying here, and that's led to some good results in the portfolio since then. If you know, we went from 25 grand in February. I didn't really do a lot of updates, which is unfortunate, in March and April and May because I was too busy. But we've gone from 25 grand, lots of buys in this area, took me up all the way to 36,000 after. And now that we've recovered quite well since then, we're basically over 40,000. So almost a $20,000 gain in 4 to 5 months, which is pretty awesome. And a lot of that is simply driven by this industry bets portfolio, which actually I've renamed growth industries because I'll talk about why, but I've really changed the way the portfolio is set up, and it's paid dividends already in the last couple of weeks. But you can kind of see here that in February, that's gone from 14,000 to 22,000. A lot of that was just pure growth. Not a lot of money flowing into that. That's gone up quite a bit too. But I want to focus on that growth portfolio here. It's gone up 15% in 1 month. It's pretty impressive. Again, it's not a lot of dollars in that portfolio, but the level of growth I've seen it is pretty awesome. So the aristocrats portfolio has been pretty flat, just like the S&P 500, down about 2.5%. This one's down about 1%. That includes additional money flowing, not a ton, but a bit. So I think overall the aristocrats are actually trailing the S&P 500 because they don't have a lot of exposure to tech. On the growth industry side, it's a 15% bump in 1 month. Again, some additional money there, but not a lot. But a lot of it is just purely driven by excellent growth in a lot of those holdings, and we'll dive into those details soon. On the forward income side, we're up to about 683 bucks off of a $42,000 total, which is a forward yield of about 1.6%. So again, this is not a dividend focused portfolio. The aristocrats do yield about 2.9%. So there is a dividend focused, but the growth industries yield is really maybe like 0.5%. That's more on capital appreciation than dividends. The dividend aristocrats really focus on the dividends, and really that hasn't done fantastically in the last couple of months and even a year or so. It's the growth that's been a success, but again, things could change. When the aristocrats do well, the growth industries probably aren't doing great. When the growth industries are doing great, the kind of boring stocks that the aristocrats sometimes have in its holdings might be doing a bit worse. Let me refresh this so it doesn't go to sleep in the background here. So now just to see the dividend payouts here, that's growing as well. You can kind of see that in June, I had $73 almost in dividends. That's off of 16 bucks in June 2019, and growing from the 40s and 30s for the last couple of months. So June is a big dividend month, so that's more comparable to March. But it's awesome to see that grow, even though this isn't fully a dividend focused portfolio. Half of it right now is in dividend focused, dividend growth stocks, and it's awesome to see 73 bucks. Again, 73 bucks isn't a lot of money, but that's 4 times more than I had last year in the same month, and it's growing quickly, and it's money that I can reinvest in stocks that I have in the portfolio. So let's take a look at those two portfolios. First, let's just kind of look at the dividend aristocrats portfolio. Like I said, this one has been kind of a steady eddy, and that's the idea behind this portfolio. This is companies that have paid and grown their dividends for 25 years in a row. So obviously there's a good history here with these companies. These are companies that have been around for a long time. They have paid and raised dividends for a long time. You can see a lot of companies you probably know, like Johnson & Johnson, Coke, Lowe's, Walmart. So these are just customer staples. Not a lot of tech in here, which is why the performance has been lagging lately. But in essence, these are companies that I think are a good investment based on their historical performance in relation to the S&P 500. So they've lagged the S&P 500 recently, but I did a video on this earlier. You can check out one of the earlier episodes, and I'll link it in the description below, where this portfolio across a long period of time has beat out the S&P 500, which is why I'm investing in it. So right now it might not be doing too hot. In the last month I'm down a couple percent. If I look at the portfolio itself over here, the last month is down about 5%. On a money weighted basis, I'm down 6% because of some additional cash flow that flowed in the last quarter. This portfolio is still up 14%, but that lags the S&P 500, which is up about 18% in that same time frame in the last year. And this isn't a full year, unfortunately, because one of these stocks split for 420, so I can't really get a good basis on that. But again, it's also lagged the S&P 500, which is up a couple percent. This is also up a couple percent, but not a lot. And this 14% is, again, off of the sort of lows that happened in March and April. So it seems impressive, but it's really not, because the S&P 500 is also up 18% in that same time frame. So again, the idea behind this portfolio is more of a safety portfolio than something that might be focused on growth, where, less volatility here, historically good performance still, and a focus on dividend payers and dividend growers. So there's certainly more focus on dividends here than there is in the other portfolio. You can kind of see that in the activity. If I look at just dividends, it's really cool that I'm starting to see numbers that are actually pretty decent now. I mean, decent is one man's decent is another man's crappy, but for me, this is great. I'm seeing $2, $3, even $4 in certain stocks now, and before this was like 7 cents, 12 cents, 13 cents, because I didn't really have any money in each individual stock. But now that I have 20 grand in here, there's 55 stocks in here because Ross Stores was removed recently because they suspended their dividend. The payouts are becoming decent, so $1.76, $1.59, $2. So on certain days like July 1st, I got like $9, $10. There was another day last month, June 15th, where I got like $9, $10. And again, that's not a lot, but it's kind of cool to get that income coming in. And June 10th was another cool one where it was like, hey, 262, 346, 223, 471, all that stuff adds up. And the way M1 does things is that anytime I get cash and it accrues up to $25, it reinvests it based on the slices that I have and the companies that are under allocated. So the idea behind this portfolio is you've got 55 dividend aristocrats. They're equally split within the portfolio. So anytime one becomes under allocated, more money gets put into that portfolio, into that stock rather. And I've split them up into two slices just to make it work easier. And there are a few stocks that are a bit overweight because 55 doesn't split equally into whole numbers, but overall that's the idea behind this portfolio, and it's done okay so far. Since I started this, it's lagged the S&P 500, but like I said, historically this thing has done well, so not too upset about the performance there. And again, this is a long-term holding for me, and the dividends will continue to grow. The dividends will continue to appreciate. I'll reinvest more of that money into those dividend-paying securities. Those companies will raise their dividend as they have done in 25 years or more, and I'll continue growing those dividends. So that's the idea behind this portfolio, to have income to live off of and also get some capital appreciation beyond that. But it's not like anything that I expect to grow at a massive rate. It's just something that I expect to be probably around or slightly better than the S&P 500, with maybe slightly lower volatility and higher dividend payouts and probably higher dividend growth. And this doesn't mean that these companies are 100% safe, that these dividends are 100% saves. Like I said, Ross Stores, ticker ROST, was a company that had to suspend their dividend because of the pandemic. situation and the impact on their earnings. And it's possible that more of these 55 companies will cut or suspend or not raise their dividend in the coming months, which means they would be removed from this portfolio because the focus here is on companies that grow, maintain, and continue to pay out their dividend, right? So if you cut your dividend, if you don't grow your dividend, if you suspend your dividend, you are no longer a dividend aristocrat and you are no longer part of this portfolio. And I do have a video on this, like I said, and you can go back and watch why it makes sense to invest in a dividend aristocrats portfolio. But I think it does, and I'm continuing to invest in it. So the bigger success on this side is the growth industries portfolio, which I renamed growth industries before. I think it was called industry bets or something like this. And I made this more focused on growth stocks. So since the last update, maybe like a month, basically right after the update, and I might have mentioned it in the last video, I really looked at some of the allocations I had in this portfolio and I adjusted them. So the first thing I did is I had about a 7% allocation to sin stocks, which was like alcohol, coffee, tobacco, etc. And those didn't really fit in with the theme of the portfolio. I don't think those stocks are bad. For example, I loved Sam Adams and I had a big gain on Sam Adams, but I just didn't feel like it worked within the portfolio slices I was trying to maintain here. Really, the focus on this and the way I imagine this is if I was a portfolio manager, I would be managing probably a portfolio of growth stocks, things that I don't necessarily own in my day-to-day investing, like in my 401k, which is just standard, S&P 500 index or standard small cap index or whatever. I want to make investments here on companies that I foresee being something great 10 years from now, right? So these are mostly growth companies. These are companies that I think have the potential to be much bigger than they are today 10 years from now. So this is a long-term view of the companies that I have here. And a lot of those companies that were in that sin stock area just didn't fit that vision. They were basically mature companies, not bad companies by any means, but I didn't see them as growers. I didn't see them as really having a massive potential impact on my overall portfolio in 10 years time. I just thought they'd be like, okay, steady eddies. And in fact, recently they've been horrible performers across the board. So I was just like, I have exposure to that stuff in some of my other accounts on Fidelity or Vanguard where I have either dividend ETFs or index funds. I just didn't really care to have them in this portfolio. So I removed them all, sold them all, and reinvested the money into some of these other allocations. The other change I made is that this random industry slice used to be called aerospace technology, but really the idea behind that is like, hey, how can I invest in the space race? And there really aren't that many companies right now where that's plausible, where they're publicly traded, where you can invest in something that's that far out. So while I had that idea, it didn't really fit. There weren't a lot of companies that fit the mold right now, and because of their dependence on travel, most of those companies, and their dependence on essentially the travel industry, those weren't doing well. And I don't foresee them doing well in the near term or even in the next couple of years because of the pandemic's impact on travel. I changed this to be more of a random industry thing where I can make adjustments to other slices in a way that allows me to have more of a holding that I like that a slice will allow me to. So for example, if I really like a company that's in the e-commerce slice, but it's already kind of maxed out based on the allocation here, but I want more of it, I can just toss it into the random industries pile, and that'll just give me more of it. It's kind of like a catch-all for, hey, I want more of this certain stock that may be already maxed out in the other pile based on the holdings I have in those slices. So I'm going to put it in here and really increase my allocation to that stock. So you can kind of see that I have, hey, if you look at the random industries area, Hopefully it'll load one of these days. You know, I've got Microsoft in here, not really aerospace. I've got Amazon, and I still have to make some changes to this slice because there's still a lot of those tech aerospace companies in here, and I don't want to sell them by any means, but I might reduce my allocation to them. I might sell a few that I don't really like, but really the idea here is to say, hey, if I look at my holdings, I've got $500 of Mercado Libre, $468 of Mercado Libre. I like Mercado Libre, but if I want to add more Mercado Libre in my e-commerce slice, I have to take down something else, because my allocation here is 13%. And if I want to change that to 16%, I may have to take down Shopify, or I may have to take down Amazon, or I may have to take down Alibaba or C. And maybe I don't want to, because I really like those companies as well, and they're doing well, and I really don't want to remove them. So I can just go back to this random industries pile and say, I'll add Mercado Libre over here at a 5% allocation or something, so that it gets me to that overall target allocation that I want for my overall portfolio. So that's kind of how I'm thinking of that slice. And those are the main changes. So I've gone down a bit in terms of holdings. I think I was at like 80 something with all those SIN stocks. I deleted those SIN stocks. I did add a few stocks. I added C, which is a great company out of like Singapore. They work in the Singapore, Taiwan area. They're really in the fintech, e-commerce, video game space in that area. And I think they're going to be really big they're already pretty big, but I think they've got a lot of growth ahead of them. I've added a couple of other stocks here that I think are solid that I might want to take up my allocation to as well. Stocks like Cloudflare, stocks like what else did I add here? Stone company, which I actually saw Berkshire Hathaway owns. I was surprised by that. Datadog. So a lot of growth companies that I think really have a bright future. And really what's come of that is I've been really richly rewarded in the last month and really the last quarter when it comes to this portfolio, because you can kind of see that in the last month, even though the S&P 500 is down about 2%, my other portfolio is down a couple of percent. This on a time-weighted basis is up 8%. The growth industries slice on its own is up 9.5%. So this is that slice without any additional money that's flowing in. In the last quarter, I'm up almost 50%, which is crazy, given that the S&P 500 is up 18% and the other portfolio is up above 14%. So that's a big chunk of change. If you just look at the quarter, I've got $13,000 invested here and $5,000 in market gains from that money. So that's pretty great. That's a pretty freaking good return, and I'm really happy with that. And I'm thinking that can't continue forever. This last couple of months have been really, really good for the stay-at-home tech stocks. Those have really become quite pricey. If you'll just look at the one quarter here, there's areas that are up 60%. E-commerce is up 60%. If I look at the last month, my Etsy holdings are up 40%. My Shopify holdings are up 40% almost. That C holding that I added is already up 33%. Amazon, my biggest holding, is up 20% in one quarter. It's ridiculous. Wayfair is it's basically doubled. Etsy's doubled. Shopify's doubled. Mercado Libre has almost doubled. eBay has almost doubled. So there's like a ridiculous amount of winners in this portfolio. My autonomous vehicle, everybody knows Tesla's doing crazy numbers here. Tesla's in this quarter is up 150%, Nvidia's up 50%, even Apple's up 40%. So a lot of these companies have just done ridiculously well, and I have a hard time seeing that continue. On the AI cloud held tech slice, similar thing. Trade Desk has doubled. Crazy. Okta's up 68%. Editus is up 64%. Paycom is up 54%. Amazon, again, up a lot. Livongo up 43%. That's another one that I just added. I added this like 4 weeks ago, and it's already up 40%. I think it was up like 20% the other day. So good picks on my end, but again, some of it is just lucky timing. But I do think that even though some of these companies are expensive now, and some of them will probably tank because of their valuation, 10 years from now, if I look at a lot of the holdings here, and I may reallocate some here and there, I really still like a lot of these companies. I think Amazon 10 years from now, even though some people think that, hey, Amazon's really expensive, I bought it at an average price of $1,900 within this portfolio. So I think it's like $3,000 now. I think Amazon is still potentially a value based on what they can do 10 years from now, what they can be as a company 10 years from now. I think Microsoft, same thing. They have so many business models that are working well, that are growing really quickly. And yeah, they're valued very richly. And that's a risk. But I think these companies are still growing at such a pace, and they're using their scale to do things with their money so well that they're just amazing companies, and I have no problem investing in them. And now there's other companies in here that are just so richly valued, like Shopify right now. I think amazing company, but their valuation is out of this world, and they have to grow at a really fast clip in the next 10 years to really make it a worthwhile investment today. And maybe they will. I'm still holding it. I'm not planning to sell anything. I probably wouldn't be buying a ton of it. Like I wouldn't be adding Shopify to my, hey, I want to add it to my random industries allocation because I want to hold more of it. But I'm still holding it, and I'm very bullish on the company 10 years from now. I just don't know if the valuation today holds up. And that's related to the market as a whole. A lot of stuff, pardon me, like I said before, a lot of stuff has happened this year. And if you look at the S&P 500, 1 year out from now, we were at 29.75. We're at 31.50 today. And again, there's, the Fed's printed quite a bit of money since then. Things have picked up from the bottom here quite a bit, but there's still a lot of risks ahead of us, I think, across the board, whether it's health-wise, whether it's employment-wise, whether it's debt-wise from a governmental perspective, whether it's travel, economy, jobs, there's a lot of risks, and those risks weren't really there in July of 2019. So for the market to be up, $200 since then, it makes me think that, hey, things might be overpriced. So whether it's growth stocks or whether it's even dividend aristocrats stocks, things might be slightly overpriced, and I'm okay with that, which is why, I'm still putting money into this portfolio. I'm not putting as much as I did. Also because I don't really have that much money to put in right now. There's been some expenses on the personal end, but I'll certainly get back to putting more money into this portfolio. But I still think, maybe 1 to 2 years from now, I don't know if this portfolio will return another 50% like it did in the last quarter, but I think 10 years from now, this will be a very profitable group of stocks because I have full faith in a lot of these companies. I think a lot of these companies are amazing. I think a lot of these companies are here to stay, and I think a lot of these companies have a lot of growth ahead of them, right? Which is really what I'm focused on with this portfolio. So it's awesome to see it perform so well in the last couple of months. I will make some adjustments to this portfolio. Probably removing or reducing the exposure to some of those old aerospace stocks that I had too much exposure to, and kind of adjusting some exposure to some of these smaller allocations that I have that I really like. For example, I really like Cloudflare 10 years from now, and I only have $134 because of how busy my AI and tech slice is. So I may add some more of that. I may reduce some of these other holdings a little bit, but we'll see. I think there's a lot of opportunities still for growth for a lot of these companies. A lot of these companies on the smaller end of my allocations are still very small. These are sub $10 billion companies. And if you think about, hey, this company's worth sub $10 billion, now we're in a world where there's already 4, I think, companies in the $1 trillion space. 2 companies in the $1.5 trillion space. There's a lot of runway for growth for a lot of these companies. There's a lot of opportunities in taking advantage of technologies that didn't exist 10 years before in relation to how we view these companies in the future. When I look at 2030, are these companies going to be worth more than they are worth today versus what they were worth in 2010? And I think the answer is yes. On the other hand, some of these companies, some of these dividend aristocrats companies may suffer as a result of that. and we'll see how that goes. But the reality is that I may be wrong on this assumption, right? I may be wrong on a lot of these positions. I may be wrong on the dividend aristocrats, which is why I hold both portfolios, because I think there's potentially upside in both. There's potentially downside in one or the other. But I really doubt that there's downside in both in the long run, right? Stocks generally do well in the long run. And I think both will do well in the long run here. I wouldn't be investing in them if I didn't. But I do know that there's certainly probably more risk with this portfolio than there is with the other. But the beauty of this is I hold 79 positions, so I'm not really at a huge risk if one or two of these companies really fail. And I'm sure they will. There's probably some companies here that are valued at 100 times sales right now, or 50 times sales, or 200 times earnings that are not going to pan out, where, you know, $100 share price is going to become $5 10 years from now. But there's probably companies here that are valued at $10 to $20 that are going to end up being 10 to 20 to 30 to 40 baggers, like Amazon or something like that. And that's kind of what I'm betting on, that I'm going to have a couple of those amazing returners that are going to wash out some of the other ones. And then also this portfolio also holds a lot of companies that are already in the mature phase, right? Microsoft probably isn't going anywhere. They may be a bit richly valued, even though I don't think so as of today. But they're not going anywhere. They're going to be fine 10 years from now. Same for Google, same for Visa, same for Apple, same for Amazon. Amazon, you can argue, may be richly valued. Some argue that it's not. They're going to be around 10 years from now. Adobe's going to be around 10 years from now. Nvidia is going to be around 10 years from now. MasterCard is going to be around 10 years from now. So the majority of these holdings are not super speculative. There are some speculative holdings here, but there's a small allocation in that if the performance is amazing, the portfolio will benefit quite well. But if the performance is actually terrible, it doesn't really impact it that badly. So that's the one thing to keep in mind when you're investing in something like this. Growth industry stocks have a tendency to be boom or bust, right? Right now we're in a boom phase. Hey, 30 to 40% returns in a quarter means you're booming, but you could just as easily drop down 30% or more. You know, we went from $120 here at a high down to $80 with the market, back up to $150. So, you know, we're basically up like 70% since the bottom here, which is crazy. But we were down, you know, 30% from top to bottom there. So there's certainly ups and downs, something you have to keep in mind. But right now, hey, I'm very happy with the portfolio, and I think it's looking good. And I'm eager to see where it goes from here. You know, I'm putting more money into this as soon as I can get it. This portfolio isn't really driven by dividends, but they do happen from time to time. Some of these companies I don't even own anymore, but they still paid out a dividend because I held it at the time of the ex-dividend date. And I'll be making some adjustments to this portfolio, like I said before, to kind of add to allocations that I think are a bit underweight. But overall, you know, I think these industries are worth investing in. I think these industries are, in a way, the future. And as more companies arise that I think are worth investing in, I love the ability of M1 Finance to just kind of allow me to add these companies and have a small slice devoted to a company that I love. And again, this is aggressive investing. I think growth comes with a very different set of risks than, you know, the S&P 500. Like, obviously the S&P 500 can drop 50% like it did in 2008, can drop 30% like it did a couple of months ago. But it'll eventually come back because it's a very, very diversified set of companies, and it kind of represents the American economy, and that economy is probably still going to be strong 10 years from now. Whereas with growth companies, if you're focusing on specific industries, those industries could not pan out. Those companies could go to zero. Now, since I hold 79 companies, it's highly unlikely that all 79 of these companies go bust, but some could, and that could definitely impact your overall return. And then growth will also have bigger dips than the S&P 500 and potentially longer recoveries. You know, just take a look at the tech bubble in 2000. You know, the growth companies were valued somewhere in the 60 to 70 PE ratio range. They dropped They dropped well into the bottom. A lot of the companies lost 100% of their values. Some lost 70, 80%. It took them decades to recover. Look at the Nasdaq, which is a good approximation of stocks, right? It was at $111 at the peak in 2000. Now it's higher than that now, but it took it kind of like Microsoft until 2017 almost to recover. So if you're buying at the peak, and if today is the peak for a lot of these companies, and I'm buying, maybe 10 years from now is not enough. It took the Nasdaq 14 to 15 years to get that money back. So hey, be wary when you're investing in stuff like this, but there's certainly a lot of upside if you pick the right picks. It's not for everybody. I think most people should be invested in the S&P 500 and just kind of forget it, set it and forget it. But as long as you're aware of the risks, you're aware of the fact that you could lose it all by investing in growth stocks, there's a lot of upside, and I'm fine with that. As long as you're diversified enough, you're probably not going to lose it all. But again, do your own diligence, talk to a professional financial advisor. I'm just doing this for entertainment, really, and for my own personal tracking. But beyond that, thanks for watching, guys. I'll be back with another update, and hope you're staying safe.